It is November 14th after hours. Taking a look at the S&P 500. We've had our event with Powell tonight, and futures headed down a bit, but they do seem to be recovering as well. Things aren't quite as terrible as they looked a few minutes ago. Right now, here's ES. This was the move down in the after hours, and as you can see, so far we're holding a higher low against the one that we made in the session today, and we're moving up off that low. So if the market is digesting what Powell said, apparently he just toed the line on everything that he has said all along. That on every single meeting we'll have a press conference afterwards, which means that we could raise, we could lower, we could do anything. But there is no more of this assumption that there will be no rate hike just because there's no press conference after the meeting, because they're starting with next month, with December. Okay, so initially the market took that badly, but it does. There's a lot of talk about this death cross thing. I wanted to address that real quickly, and that's the main reason why I'm doing this video right now, to prepare us ahead of tomorrow. But we're looking at my gap map right now, less crowded with notes, even though it's starting to get a lot. Last Thursday, and here was last Friday. Okay, so when we came in last Friday, you can see right here the 10 and the 20-day simple moving averages were both rising, and they were meeting for a bull cross. And that's the opposite of what happened back here at the beginning of October, where they bear crossed, and as you can see, that led to that first major spillover down in the S&P 500, exacerbated by the 10-day following through and crossing down through the 50-day. Okay, and then the 10-day crossed down through the 100-day, and it crossed down through the 200-day, and here we were making our low, and we bounced back, and we got these moving averages to turn and to start to move up. And first we were going to have our 10 and 20-day simple moving average finally cross again, but we came in on Friday, and there was clearly an effort made to treat that as an overbought situation. So we began selling off and away. The selling followed through on Monday, Tuesday, and again today. And unfortunately, what has happened now is that our 20-day has curled over and is now descending. And without getting too wonky on you, that sort of voids the bull cross that it's in. But what's really sad here for the bull case is that what is being fended off, and you can see the 10-day now starting to turn over and descend, is fending it off from crossing up through the 200-day. Because I think that if that had been allowed, I think this would have been a head fake selling event, and that this would have been allowed to cross up through the 200-day, and then we would have had a more major buy signal go off. But of course, in the meantime, while all this shit's going on down here, what we had going on up here was that the 50-day simple moving average was making its way towards crossing down through the 100-day. So there is this talk of the bear cross going on around Twitter, and some goofy thing about the 30-day dropping down through the 100-day. Well, what's much more important and much more likely watched is the 50-day dropping down through the 100-day. If you've seen the little key that I put in the blog, and I post it every once in a while, explaining what these simple moving averages represent in time. But the 50-day is about a quarter's worth of trading, and the 100-day is about 6 months worth of trading. So you've got your quarterly average price, closing price of an S&P 500 component, dropping down below that of what the average closing price is of the last 6 months. So if you put that all together, you take it as, why should I buy now? Prices are now less than they were 6 months ago. Maybe they're just going to get lower still. So, that is the death cross that people are talking about, and that's been allowed to go through. And as you can see, it's just starting to thread today with this follow through on the selling. So what's going to happen now? Well, maybe we're going to go ahead now and head on lower, break this low at 26.03, and break down through our 25.32 low and go after filling this gap to September of 2017. And as I've shown you before, this rhymes a lot with a double down target of taking the all-time high to this initial first low that we made here in October at 27.10.51. Doubling that down, that would get us down to 26.80. Okay, So if we were to just push over that just a little further, we would go ahead and fill this gap. Okay, filling that gap gets us down to 16.3% off of the all-time high. That rhymes a lot with a nice 15% correction plus a little overshoot. And maybe we're going to do that now instead of stopping here, rallying into the end of the year, and then completing this correction maybe in 2019. And maybe what's going to happen is something much worse now. Maybe we're going to go ahead and have this, finish this part of the correction now, and I mean now, like this week, and then bounce next week into Thanksgiving and maybe bounce a little further into Christmas, but then come back and really kill off everybody in 2019 as we get into January and February with more rate increases and more press conferences from a Fed chair who's basically like, it just let the market burn. I don't care. And when we back out the chart, you can see all these little gray lines down here. These are unfilled gaps galore, all left here from 2017. If once we fill this September gap at 2461, there isn't another gap to be filled until we get down to 2409, with the August low being the next support I could see holding us up. The August 2017 low at 2417. Okay, so there's plenty of meat on the bone. We could be going all the way back to the post-election low of 21.25. I talked about that in the previous couple of videos that introduced this 24.80 to 24.60 target. So, I mean, we could be going all the way back there. Maybe this is part one of our sell-off, and part two of our sell-off next year is going to be getting way down into the weeds here. I don't know, but in any case, just wanted to update you on that. If we're going to have a good day tomorrow and all of this is really like overshooting and that we're not going after this 2400 level this week, then obviously when we come in tomorrow, we've got to make some progress on taking back the 20-day, the 10-day, the 200-day simple moving averages, and possibly shooting for a monthly OPEX that closes back above the 200-day simple moving average. Or I should say opens on Friday above the 200-day simple moving average, because that's what monthly OPEX is all about. The options will trade through Thursday tomorrow, but they will expire on the average opening price that we get on Friday. And it uses this ticker here, ticker SET, S-E-T, for settlement. That's the average settlement price of the components. And all this chart is like these little ticks, because there's just one tick per day that you get. And the one from last month for October, October settlement was at 27.75. So if we're shooting to surpass October settlement, have a higher settlement this month, then we could be looking at a big rally tomorrow to try and get us up over 27.75. But the components within the index are what complete this. It's really not about what the ability of the market to manipulate through the options and the use of ES. This is that one time a month where it really is dependent on the components. And as you know, they really took a hammer to Apple today, and that's a big component of the S&P 500. So, you know, if we see like big rallies and things tomorrow, such as Apple and the rest of FANG, if we see a recovery in Boeing and other things that are big components of the S&P 500, then maybe we're going to have a broad-based enough rally that we can affect where monthly OPEX is on the S&P 500. But as you can see here on Apple, it put in a follow-through close below the 200-day, closed down below this gap fill, and is sort of hanging out here in the wind, trying to decide whether it's going to break on down further to 183.50, maybe even go down to the 180 flat handle. Right now, I see this as, you know, a great buying opportunity if these levels hold, and if the S&P 500 is going to hold up and have that end-of-year rally. This could be like a nice little chance to make some money at the end of the year if you're looking to buy Apple stock or Apple calls that maybe expire into December or into January. Anyway, I don't want to get too far off onto the weeds and start talking about Apple on a video that's supposed to be about the S&P 500 and where we're going tomorrow. So anyway, I hope this informed you. If you have any questions, just send me a DM tonight, and I will write up a more formal plan to go with this for us tomorrow. That's it. You have a good night. Good luck. And good trading if you're trading the ES tonight. Bye.